Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so mostly every other week of the market's key events and trading opportunities. While I just let you have a look at the disclaimer, I'll just run through some of the key objectives of this webinar. Markets, we think, are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. So this week, it's all about the strength of the dollar. We've been talking about this for many months now and highlighting this as the key driver in markets. And also we have this story, ongoing issue, ongoing crisis around energy in Europe. So firstly, we'll take a look at some of the moves in the dollar, in dollar yen especially, and also then the DXY, the dollar index, before then running through some of the major US stock indices and also the drivers actually of that current price action. We'll briefly touch upon and review non-farm payroll. We think that's important to do, sort of driver of this dollar strength in some ways. A Goldilocks report, some are saying actually, so not too hot, not too cold. And then that kind of really highlights the solid strength in the US economy and why we're seeing really this dollar push as well. A safe haven bid mixed in there. We'll briefly look at the RBA meeting, potentially if we have time, before then previewing at the Bank of Canada meeting today, and then probably the main highlight of the week, the ECB meeting. And hopefully if we have time, we'll touch upon sterling, GBP, that is, of course, pound sterling, with the announcement of the new Prime Minister of the UK, obviously, and potentially multi-billion pound package of support for households and businesses to try and get through this energy crisis. So markets generally have been, really, it's been a case of dollar strength. It's really a case, of trying to stop the dollar. The greenback remains really in absolute pole position against its peers. Yesterday was no different. The trade-weighted DXY, that surpassed the 110 barrier for the first time since 2002. Just running through the majors, actually, I've got the dollar yen chart on here, but euro dollar obviously closed at a new 2-decade low, just north of 99, but went as low as 98.64 intraday. Sterling's relief rally post the announcement of Liz Truss as the UK PM, the new UK PM, leader of the Conservative Party. That hasn't lasted too long, this rally, the relief rally. Cables, sterling versus a dollar, really trying to escape from the 115 barrier, and it's really struggling. But certainly the most spectacular move we've seen really in currencies, especially, has been dollar yen. The chart here, you can see really the major surging from sort of 140, around 140 at the start of the week, up to above 144. Quite amazing, quite a massive move really. And the high actually today is, just checking, 144.38. We're currently trading at 144.19 or so. I think it's worth touching on this move, really, such a big move, really, and it's been sort of down to, well, a number of things, of course. The yield differential, so the difference in rates between the US and the yen is obviously stark. You have the US obviously still pursuing or continuing to pursue, if you like, a really quite aggressive stance on its policy tightening path, whereas, of course, in contrast, you have the Bank of Japan still pursuing, still stuck on its yield cut. YCC, so yield curve control policy. That means they're capping their 10-year yields at 0.25%. So a massive difference really compared to the US and the Fed stance. That's the obvious reason, but also interestingly, a lot of questions around the safe haven status of the yen. We've seen the dollar sort of bid this week, especially due to risk sentiment sort of weakening and safe haven bids going towards a dollar, but the yen's role as a safe haven, as I say, being called into question slightly. And that's due to the trade position of Japan, which continues to deteriorate. Just looking at this briefly, worth going into really. Obviously, the war in Ukraine, has seen energy prices surge. For a country like Japan, which is a major net energy importer, so it imports all its fossil fuel energy, that means its terms of trade have really collapsed. And that is the price Japan receives for its exports versus what it pays for its imports. So a massive negative income shock for Japan, and that's most visible in its trade account, which is now swung into a deficit basically on higher energy costs. And typically a safe haven currency, we've looked at this before a few months ago, safe haven countries, they're backed by a strong trade surplus. So there'll be a natural demand for that currency in a crisis. But the yen has seemingly lost that backing from trade in this current environment. And then that means we're seeing obviously yen sellers. So two key factors for this big ramp up in dollar yen. Certainly the move in US 10-year treasury yields, that has also pushed up this major up into multi-decade highs. Technically, just briefly, I mean, it is overbought. You can see on the RSI overbought. This is on the daily. It's overbought on the weekly, that has been for some time, and also then looking at the monthly chart, severely overbought on the monthly chart. We've got these Keltner channels here, they're kind of volatility bands, which really, when we're pushing outside the upper band, really is showing how overbought it is. But we do have that level in there that you can see, the long-term level, probably that most people have looked at now, which is back from 1998, actually. August high in 1998 was 147.67. So no real levels above the current prices of where we're trading until that level 147. But of course, we have the prospect for possible intervention by the Japanese authorities. We have actually had sort of familiar FX rhetoric from numerous or from several officials overnight. But interestingly, we did get comments from a former MOF head, Ministry of Finance head, really speaking against FX intervention. I'm really saying he doesn't think the Bank of Japan will raise rates to stem the yen's decline. So really, really powerful, interesting move in dollar yen, probably the most noticeable with this dollar strength. But just really returning back to sort of the near term in general, as we've said, surging rates and this ongoing vulnerable risk sentiment has really helping the dollar against other currencies as well. I think at the first trading day of the week, actually, US yields had some catching up to do because of the US Labor Day holiday, catching up to do with European rates, which had shot up on Monday during that US bank holiday. And then that move really gained a lot of traction at the US Open yesterday and received another boost from US data yesterday. There was an unexpected rise in US services ISM, widely watched manufacturing survey, that moved from I think 56.7 to 56.9. So really decent number there, quite a surprise. On the US data front, sort of adding to the non-farm payroll field, which we'll get into soon. Of course, the other thing, the other narrative this week has obviously been gas prices, which obviously have surged since the markets opened, and especially after Friday evening's announcement that Russia would indefinitely suspend gas flows through its Nord Stream 1 pipeline. Yeah, I mean, European nations have made progress towards gas storage targets, but this early surprise withdrawal really is a heavy blow to markets who thought capacity probably would be turned back onto the previous 20% capacity. There's an EU emergency summit on Friday. That's a summit on the energy crisis, with a range of measures potentially being proposed. Germany over the weekend, they announced a $65 billion aid package of relief measures, partially funded by a windfall tax on electricity producers. But many economists think that doesn't go that far, doesn't go far enough really. 65 billion euro package that's worth around 2% of GDP, I think, which compares to, say, 15% of GDP levels of support through the pandemic. So just contrasting really and comparing with those levels, and some thinking it's not enough. That's just for Germany, of course. If we do go back to the dollar index, the DXY, we can see this chart, the daily chart. Really, we have bullish consolidation now under that 109.29 mid-July top there. We sort of moved around there back end of August, back end of last month, and then obviously pushed above it, and then came back actually during non-farm payroll. The initial reaction to that, obviously this week now we're pushing above that 109.29, which is really support, and the high, today's high at 110, I think 110.69. Yeah, 110.69. So generally, as we've sort of been saying, it's no surprise, safe haven flows you get with the dollar, and then also there's not a lot of alternatives. We've been saying this for quite a few months now. If you compare the grim outlooks in other world economies, China, Europe, compared to the US, it's a relatively strong economy, encouraging jobs data from Friday we'll get into, as I said, and then backed by as well near energy independence. And also then when you think overnight depot rates, they're around above 2%, 2.3% or so, then really not a lot of alternatives to the dollar at the moment. And until that changes, until this whole thing changes, growth possibilities elsewhere in across the world, then really the trend is your friend, to use the classic phrase. We are slightly overbought on the DXY, but again, there's not many alternatives to this. Concerning stocks, I think worth pointing out a couple of things really. The key drivers, or the main key driver, and then also some seasonal studies, I think, show that August and September combined represent the worst 2 months run for US equities over the course of the year. Those trends actually do then suggest risk appetite kind of picks up significantly actually in the fourth quarter, in the last quarter towards December, Santa rally, that kind of thing. But market breadth indicators for US stocks, really, they have been deteriorating really since the rebound in markets through the summer, really. And that's kind of adding to the negative tone for US stocks. Let me just pull up the S&P here. And really, yeah, sort of seasonal indicators, they kind of leave us with this sort of 4-week window, if you like, of the prospect of weaker equities, higher volatility. October, kind of known for dramatic crashes, of course, dramatic moves in asset markets, but it's those 2 months, if you look at seasonals going back August, September, which are the worst 2-month run, if you like. For risk markets then, for the S&P, for the Nasdaq, they've registered weekly declines. We're now, those have both dropped for 3 weeks in a row. If we look at the S&P, we can see that those 3 candles there. Let me just take off the counterbands, so you can see the 3 candles there, potentially a 4th one, so 4 consecutive weekly losses potentially. But just touching on this key driver, really, the falls really have gained steam since Jackson Hole. That was actually our last webinar just before Jackson Hole. Fed Chair Powell really reiterating the central bank's commitment to tame inflation, saying they must keep at it until the job is done. It seems, again, to coin another classic phrase, don't fight the Fed, really. This shift in central banks generally, and especially the Fed, really are now sort of hell-bent on breaking inflation while accepting the potential costs of pushing economies further into recession. Kind of similar to what we had for the markets in the early 1980s, actually. But higher rates will certainly mean potential problems for equity valuations and potentially lower price to earnings multiples. If we look at the technicals then, the S&P, this is the weekly, that downward trend line from the all-time highs early in January, the start of the year. We got a touch there with that 4325 high, middle of August. And that the light blue line is the 50-week SMA, simple moving average at 4312, 4,312. Yeah, we sort of touched there, and then obviously we've fallen down. This grey line is the 100-week moving average at 4170 now, broke through that, and also the swing high from May, which is at 4177, obviously broken down through there. I've put on actually, the wider fib level actually from the pandemic low up to the all-time high. The next fib level is the 38.2, is at 3,815. So probably where potentially bears are targeting. And if we get to the daily, then we've got sort of narrower fib levels. This is from the June lows up to basically the covering the summer rally, the 20% or so summer rally, and we're resting now on the 61.8, which is just below 3,900. So potentially support there. Otherwise, we then drop down, as I said, down to 3815 potentially, and then we're getting into the sort of June sort of choppy action, but below 3,900. Sort of 3,900 and below, yeah, as I say, 3,800 potentially there. Let's look at also then the Nasdaq, widely watched, obviously tech heavy index. If we go to, yeah, that's the daily, of course. Firstly, the weekly, probably worth looking at. Again, didn't get quite far as the 50-week moving average there, just below 14,000 now it is, but the 100-week moving average at 13,793. We touched that and obviously have come back down. We're back. We did peak above this wider sort of bear channel that I've got here, descending bear channel, peaked above that, but really couldn't stay above it, and we've fallen back into the middle of that now, and potentially going lower towards sort of below 12,000 to the 11,000 region. If I pull up the daily, just pulling back, you can see I've got some fib levels again. 12,000 level there is potential support, resistance above here, the 50-day moving average and the 100-day moving average around sort of 12,500, just above there. That's resistance, but support, if we lose this sort of near-term fib level, then we're getting back to, say, this swing low here from mid-July around 11,500 or so. One other indices, not on the US, but probably worth pointing yeah, just letting you, just signaling actually a sort of major support level in the DAX. This is the main German equity index. We've sort of fallen below the 50-day moving average there, the light blue line at 13,176. And we've got major support. We've highlighted here a couple of dotted lines around 12,400. A lot of people looking at that as huge support, really. Which potentially we could bounce off. Obviously, if we break through it, then we don't see that much left. Well, there is back in July 2020, 12,253 potentially, and then we get down to the sort of October lows, sort of just below 11,500. That's in the DAX. Okay, quick recap. I think it's worth recapping, as I've said, on the non-farm payroll report from last week, sort of driver of, or just really highlighting the solidity, if you like, in the US economy. We saw moderate cooling in the headline number, 315,000. I've got the graphic here, just pointing out, just highlighting the key numbers really from the non-farm payroll report on Friday. 315, the headline, as I say, 2 months prior of data were revised lower, 100,000, over 100,000 lower. Probably the key number, average hourly earnings, that rose only moderately at 0.3% month on month. So that was below the 0.4% pace of the prior 3 months. On a yearly basis, the increase is pretty stable at around 5.2%. Then unemployment, that rose 3.7%, up from the 50-year low of 3.5% that was. But this was probably somewhat on the positive rise in participation rates. So essentially more people seeking work. We put there the 75 basis points hike in the FOMC meeting coming up. That fell actually, chances of that in the Fed funds futures fell to 58% from 72% just before the non-farm payroll release. But now actually that's gone back above 70% now, with a couple of data points as well. Really pointing out this solidity, as we say, in the US economy. Just generally, many economists on the non-farm payroll, they point out the fact that August payrolls are subject to higher revisions than any other month. I think over the past 5 years, the first release has undershot the third by over 100,000, and that compares to an average undershoot of 23,000 for all months. So probably don't interpret this data too much, but it just sort of backs up generally what we've been seeing. 3-month average job growth now in the US, really healthy at around 378,000. But overall, sort of a benign report, if you like. Goldilocks report I've mentioned, sort of not too hot, not too cold. The main focus of that wage data, and it's staying relatively muted. So fears of a wage price spiral, if you like, may be overblown. That's sort of comforting to the Fed. Supply chains are easing as workers return to the labor force in that participation rate. And it kind of doesn't change that much for the Fed going forward. Potentially, if that wage growth comes in lower, then we may see a possible slower pace of rate hikes after this probable 75 basis point move in a couple of weeks at the Fed meeting. Yeah, the peak rate is seen sort of has got back now close to 4% again. So that's the terminal rate for the Fed funds rate by March of next year. It did fall after the non-farm payroll to sort of around 3.8%, but I think it's back now above 3.9 towards the 4% level. Remember that the current target range for the Fed is 2.25 to 2.5%. And the next big event, well, that will be the US CPI report next week, next Tuesday. But we also have this week, actually, numerous Fed speakers, several today, in fact. Brainard on the slightly more dovish side has been historically, and also then we get, I think, Mester as well on a more hawkish side. And then tomorrow we have Powell, Fed Chair Powell speaking. He's expected to remain hawkish, really. Nothing much has changed. It is the last chance to shift rate expectations before the Fed's blackout period ahead of its meeting. Remember, the blackout period is the time 2 weeks before the Saturday preceding the next Fed meeting. I also mentioned a couple of other data points. We had ISM services, and last week as well, manufacturing, ISM manufacturing PMI numbers. That's the activity level of purchasing managers in the manufacturing sector. Reading above 50 indicates expansion, below 50 contraction. And that manufacturing ISM surprised to the upside as well. So 52.8, I think, in August versus 52 expected. Another decrease in prices paid, actually, as well as increases in components like new orders. So some, again, economists labeling it as a Goldilocks print, but certainly it's only one good report after a series of bad ones, really. So something to look at going forward. I did mention the RBA report, the RBA central bank meeting. Just touch on that briefly. No surprises in a way. Hiked by 50 basis points in line with expectations. There were no new economic forecasts, but policymakers really noted that the outlook for the economy slightly more negative, but higher rates may impact consumer spending. That's probably the key variable, but then wage growth is picking up in some sectors. The bank really expects more tightening further out, but it's not on a preset path. I think data dependency really is a key word these days, and especially as rates are now near neutral for the RBA. This means there's a greater chance that rates may now continue to be raised, but at a slower pace. And I think the key thing here, just for the RBA to note, is that they meet their meetings are monthly, as opposed to obviously other central banks, which are probably 6 weekly and beyond. So really, you might see that slower pace of rate hikes going forward because they meet more often. Okay, let's just check the other central bank meeting, which is the Bank of Canada meeting today. And then we get obviously the ECB meeting tomorrow. Just another graphic for the Bank of Canada. You can see really markets expecting another, a 75 basis point increase in the overnight target rate. And that would take rates to 3.25%. There is a case potentially for a smaller 50 basis point move as the inflation outlook has improved sooner than the bank anticipated, but it's still elevated really. You can see there 7.6%, slightly lower than the previous mark. And also we have obvious sort of external growth clouds, if you like, potentially then seeing analysts forecasting a smaller 50 basis point move. It is a statement only affair for the Bank of Canada today, so we probably won't get too much color on the outlook for policy. But just remember, the bank obviously surprised by hiking by 1%, 100 basis points in July, when the governor, Macklem, said the central bank wanted to speedily get rates to the upper end of its 2 to 3% estimate of where neutral is, or even actually a bit higher. So it'll be interesting if there is any color at all on that. Now we're in sort of slightly restrictive territory potentially if we do get that 75 basis point hike. Markets price a peak rate currently just below 4%. So overall, I think the consensus really sees the bank probably actually persist with this strong messaging on curbing inflation. That's what consensus is going for. That's still well above target, the 7.6%, obviously still way above the 2% Bank of Canada target, and the labour market still remains pretty tight. The statement then is probably likely to stress actually that policy, as I said, is becoming more restrictive, but there's probably still more work to be done. I guess if the central bank potentially uses those sort of data dependency phrases, or meeting by meeting is what we're seeing now, then potentially that could sort of signal a slightly more dovish stance, and the loonie, so Canadian dollar, you may see some selling there. If we just pull up the dollar CAD chart, which let me just get for you. Bear with me 1 second. That's here, so we can see it here. Yeah, the dollar CAD daily chart, potentially into yeah, we could get some volatility. You can see the last week's push actually through sort of 132 and was approaching this key sort of spike high, the mid-July spike high at 132.23 there. We didn't get quite as far as that last week, and then we've sort of oscillated around, but above 131 noticeably, and above that previous sort of support resistance, springtime highs around 130.76. We've kept above there, so really it looks like potentially bullish consolidation again. Interestingly, today that price action again, though, resisting and again pulling back from the sort of 132 level. So interesting couple of candles there, shooting star potentially last Thursday, and then again potentially today, but obviously a Bank of Canada meeting in a couple of hours only. So support, as I say, 130.76. If we do break down below that, then we've got then well, the 50-day moving average below 130 really. So yeah, something to keep an eye on certainly as we get towards the Bank of Canada meeting in a couple of hours. It's probably also worth keeping an eye on crude, always a big driver for the Canadian dollar, and this is Brent crude actually prices, which are nearing, they've pulled back from this sort of key support level around $91 or so. So that's worth certainly keeping an eye out for a driver for the Canadian dollar. If we do lose that support level, then we sort of go into where the 90s or so and below potentially. That black line there is the 200-day moving average actually at 98.91, 50-day moving average just below 98.84, sort of resistance above, with probably near-term resistance around 96.58 if we do hold the 91 support level. Okay, let's finally move on to probably the main highlight of the week, the main risk event certainly, which is the ECB meeting. Just lost track there. The ECB meeting and the big driver of euro dollar certainly has been European natural gas prices, which on this chart here show you how they remain still very, very high and really are acting as a huge tax hike. So that sort of the energy crisis, the energy shock is obviously clouding the ECB meeting, which we get on Thursday. Just worth recapping, I think up until a couple of weeks ago, expectations for the ECB meeting had been coalescing around the prospect for an additional 50 basis point hike. That would have taken the depot rate up to 0.5%. But then we had sort of more hawkish rhetoric, a lot of hawkish rhetoric actually. We had a source report at the end of August really revealing that some policymakers wished to discuss a 75 basis point rate rise due to the deterioration in the inflation outlook. And then with the prospect of a looming recession, that really wasn't a justification for slowing or halting policy normalization. Since then, we've had a lot of chatter from the ECB hawks, really ramping up the chances of this bigger hike. And we've also had August inflation data, which saw the headline rate climb to a record high 9.1% year on year from 8.9%. And also the core measure, something that the ECB really focus on, strips out those more volatile elements, that advanced to 4.3% year on year from 4%. And that really prompted concerns that second round effects from energy inflation are really making their way through the economy, sort of broad-based increases in inflation. Flip side really to the hawks, the doves, they've been noticeably quiet. Really only the chief economist Philip Lane saying that he'd prefer kind of step-by-step hikes to make sure financial markets have time really to absorb the tightening in a more measured manner. The markets, well, they've really come out in support of a 75 basis point hike this week. I think there's around 68 basis points priced in currently, so pretty much close to that bigger jumbo size rate hike, if you like, expected by the ECB this week. That would be the biggest increase since 1999 and only the second time in its history. And then markets then pricing, suggesting a potential 50 basis point move in October. I think there's around a total of 150 basis points of tightening by year end, including this meeting. Really, so an important question is whether the ECB do front load this hike, or whether the terminal rate, the end rate, is perceived to be higher than at the time of the previous meeting in July. I pulled up this chart. I mentioned the gas price as being a key driver of euro dollar, of the euro essentially. It's a bleak outlook really across the eurozone. The Nord Stream pipeline obviously raised downside, the shutdown obviously in the pipeline obviously raises downside growth risks and then increases also the inflation outlook. And kind of similar to the Bank of England in some ways and their conundrum they face. Obviously, if policymakers hike aggressively, they may worsen the economic outlook as the Eurozone economy obviously is hit by a winter recession. And then obviously, if policymakers do not hike aggressively, they may prolong stagflation and also then lose credibility as inflation fighters because they're losing control really of inflation expectations. So yeah, tough spot for ECB policymakers for sure. We have mentioned that that summit on Friday around the EU energy crisis and potential proposals. And it's worth noting, obviously, if we do get some kind of EU-wide cap on energy bills, then that may put a lid on inflation expectations and possibly give a lifeline to the grim economic outlook that we're talking about. So something to watch after the ECB meeting on Friday, and whether we get some kind of, as I've said, EU-wide cap on energy bills. For euro dollar, let's just bring up that chart. Just bear with me 1 second. So yeah, obviously a strong downtrend that we've seen over the last few months, obviously since the start of the year. Series really a descending bear channel. You can see series of lower highs and then lower lows. We did get that tracking sideways through the summer, and potentially was hoped for a base around sort of 101, 103, but then we dropped through that previous mid-July low at 99.52. We're kind of tracking, we've obviously made long-term lows. 98.63 was yesterday's low. That is a 20-year low, but potentially, whether we're back, this is some sort of base around parity, around 99.52. A lot will depend, of course, on what the ECB says on President Lagarde says in her statement in a press conference. But the long-term downtrend is, of course, for lower prices. Where we probably need to get above parity to slow that downtrend for sure, and get probably back towards 101 really to signal any kind of base, it looks like now. I think we've covered quite a lot actually. I was going to try and get on to sterling. Obviously, we've had that. Let me just briefly touch on that. It's an obvious downtrend that we've seen, a bearish channel that we've seen, and we're getting potentially the pandemic low, which is at 114, that spike low, 114.09. The relief rally, as we said, didn't last very long. We got just above 116 before then falling back, closing ominously near its lows, and then obviously we're moving down below 115 today. Regarding obviously the new Prime Minister, a lot will depend on what she announces regarding this fiscal package of support for the cost of living crisis. Obviously, the 130 billion is pretty much known now for households, and then an additional 40 billion for businesses to freeze energy bills. The issue, I guess, is it's likely to be funded by a bigger deficit instead of loans or grants to energy companies, and that really matters for sterling going forward, because it has an impact on the growth outlook as well as Bank of England policy. And it then has also wider implications for the UK's debt position, and that is key for markets further out, really. That's a factor for FX, and it may be increasingly sensitive to sterling too, especially those instances like the UK where there is an increasingly negative current account balance. But at the moment, the market's kind of focused on the potential for support to kind of avert the worst of the economic fall, the fallout from higher energy prices, rather than the eye-watering costs. But obviously, the more we focus on that, on the eye-watering costs, as we say, then that's a factor for the wider implications for the UK's debt positions, and potentially we see more selling in sterling, and all eyes then are on 114.09 as that low, with some obviously then looking below there towards sort of big figures, 113 and below. Okay, I think it's probably worth wrapping up there. We've looked at a lot of things going on in the markets at the moment, not only the energy crisis, but of course central bank meetings as well. They're hiking into potential recessions that we get very soon in the Eurozone, in the UK, and this ongoing dollar strength. We hope you've enjoyed this webinar. Good luck trading out there, and please register, and we hope to welcome you back at the next webinar in a couple of weeks' time.